This is the headline that's garnering all the attention today.
All the evidence shows there's a investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com. And now here's your host, Aaron Kolkman.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder. And this is A Steward's View. I'm so glad you joined us again. Check out the weekly economic and market roundup later today at astewardsview.com/blog. Our mission here on ASV is to help you cut through the information chaos of the digital era so you can be wise and decide well. That is, we work to bring light to your financial decisions as stewards. During November, we moved through a series. It was called, well, Chaz, do you remember the name?
Oh, man.
Pie Charts with Purpose. It was all about investment planning. Okay, we talked about aggregate risk. We talked about aggregate return. We talked about aggregate Sharpe ratio. We talked a lot about the aggregate, and we even talked about correlation of the aggregate. Okay, so the idea of holding assets that are lowly or negatively correlated with one another. So that was November. Now we're going into December. Here we are, December 1st. And then just before Thanksgiving, what we did is we covered a lot about asset optimization and measuring it. Okay, so this week, I did mention, and in Chaz, I don't know how your memory is here, but I said, hey, let's go to some case studies on how this asset optimization works, okay, as it relates to financial planning. So I tell you, I think we're going to set that aside because I'd like our listeners to stay awake. Okay. So, every time we go into financial planning, there's these really cool ideas. And I submit to you that financial planning is a financially speaking, a far more valuable thing to discuss anywhere with real planning professionals. Okay. I don't mean somebody that got out of college last week and doesn't have credentials, or somebody that holds themselves out as a financial planner that doesn't have any credentials. I'm talking about experienced, credentialed people, the same people I write about in the Life Cycle of Wealth book, and we can talk about that. But the point I want to make to you is that we're not going to, for the sake of keeping our listeners awake on this program, we'll stop with the idea of applying asset optimization to financial planning just for now, okay? But there's huge value in it. Why? Because when we get into asset optimization conversations and now measurement, and I have some big news on that front, Chaz, when we talk about measuring asset optimization and we talk about inserting optimized portfolios into financial plans, what we're really doing is we're saying, have we efficiently funded goals or not? Okay, and if we have, how efficiently, right? And so then what can we do? We can look at the goals themselves, their funding level, and something about the outcomes that we're looking for, right? And that can be the conversation, right? And most importantly, the relationships involved. Okay, the family picture, the estate, the giving objectives, the tax management concerns, the annual kind of big picture reviews, all of the things that go into a financial planning relationship. Okay. So what we don't want to do, unlike, a lot of places, is to go so far into investment planning that becomes the whole thing. Okay. But for the sake of this program, it will try to keep us all awake and not dive too far into financial planning topics. Okay. But again, the most valuable thing you can do with your advisors, real advisors, people that know how to do this stuff, is to focus on the plan. Okay, not to focus on the asset base. If something is broken, by all means, take a close look. I encourage you, and here's the big update, Chaz. Over the Thanksgiving weekend, we have a good group called Base 44, and I submit to you their website is amazing. It's an AI company. They build apps. Okay,
I know. Yeah, I know them.
Great. And so they helped us build an optimization calculator that's now live at fideradvice.com. So you can go out there and you can take the metrics we've talked about over the past month. You can enter those metrics for your own portfolio. And by the way, I would use a risk-free rate of 4%. That's a rounded number for current 90-day treasury bills. Okay. And I would use that calculator and I would find out. You can use our models also as an example, right? Click on models out there, but you can find out what is it that I'm doing as it relates to this allocation premium. And that's going to be the summary phrase that we use going forward. Do I have a premium from my allocation or not? Am I just lining up with the market? Like, how am I doing, right? If I don't care, I'm probably not doing this in the first place. If I do care and I'm doing this, then the more positive the number, the better. Okay. And if we have time at the end here, I will share an example of a case I did work on in investment terms and share some results as to how that calculator worked. Okay. So that's all to say, we're going to press into today the value of advice. That is the advice you may or may not be getting, and about the asset base that, again, funds your goals. So before we begin, let's take a minute. Let's examine our work in the context of God's word about stewardship. And Chaz, if you want to follow along, this is right in the beginning of the life cycle book. And this, I tell you, I really appreciate how this section of 1 Timothy, and it's 1 Timothy 6, 17 to 19, puts forward in the Apostle Paul's own language to his mentee Timothy. He's talking about what loosely I would call the treasure principle. Okay, and I'm borrowing Randy Alcorn's language there. So here's what it says: As for the rich in this present age, charge them not to be haughty, nor to set their hopes on the uncertainty of riches, but on God, who richly provides us with everything to enjoy. They are to do good, to be rich in good works, to be generous and ready to share, thus storing up treasure for themselves as a good foundation for the future, so that they may take hold of that which is truly life. So, we need to be thoughtful about what we mean by treasure, what we mean by riches. What is it that's truly life? What are we here for, and whose is it? Okay. So this is excellent grounding for a future series on generosity and giving, Chaz. I just have to say that out loud. But for now, what I want to do is I want to recall the idea associated with a steward's view, and we've been doing this since March, that we are stewards, we're managers, we're not the ultimate owner of this financial picture, this dynamic puzzle box that we're handling, and our decisions then can flow from that owner-manager perspective. Okay, so with that, let's get moving towards the content we have coming up this week on the value of advice, and we're going to stay there for a week or two. But before we do, let's just take a quick look at our noise segment, and we'll take a break as well with our commercial.
Investors have holdings scattered under multiple logins. Now there's one place to put it all together. Your entire portfolio in one place. Every asset house, every holding, every transaction, every day. It's called Fusion. Fusion means ongoing portfolio aggregation, without a contract and without a hitch. This important tool can put all your investments into a single view with a universal login, provided by Morningstar and sponsored by Fidear Advisors. Fusion gives its users the benefit of a constant monitor and quarterly risk-reward reports on the entire portfolio. So take a break and take advantage of this valuable view. Register now at fidearadvice.com. Just click Fusion at the top of the page, or type in fidearadvice.com/fusion. And now back to A Steward's View.
Okay, Chaz, so do you have a noise segment in mind for today?
I sure do, brother. I'm excited to show it to you because this is, we haven't done this in a bit. This is the this or that, the higher, the lower. And today, Aaron, you are going to be going up against one of the most obnoxious financial people on the planet. And I'm really, truly looking forward to this. Get ready.
Okay.
Can you see that, Aaron?
Yeah. I think he's familiar. Sure.
We've got the Mad Money guy. What's his name? Kramer?
Mm-hmm. Yep.
And as we get into this, I'll try to cut him off so we don't get a glimpse of where he's at. But the thing with this, Aaron, it's just kind of gut reaction. But at the end of this series, you can kind of give a little bit of your heartbeat about maybe why you picked, especially if you guys deviate. You might be the same. We'll see. All right.
Sounds great.
Here we go.
Buy the dip or wait for confirmation?
Oh, am I supposed to respond right now?
Yeah, before he does.
I'm hesitating to buy anything right now, so wait for confirmation.
Dip.
Okay.
Being right or being early?
Being right.
Right.
Cash is trash or cash is king?
Cash is always king.
Trash.
High yield savings or T-bills?
T-bills.
High yield.
Dividends or buybacks?
Mm-hmm.
It's interesting. This guy normally is just such a mouth, and he has such a thought. He's being more thoughtful than I ever have seen him be. But what do you think, dividends or buybacks, brother?
Yeah. I'm going to say buybacks.
Dividends.
Oh, I love that you're disagreeing. We got to go back to these.
Well, I'm just more conservative than he is, but okay.
That's okay.
Free cash flow or revenue growth?
Every time, free cash flow.
Free cash flow.
Dividend aristocrat or high growth?
Oh, man. Dividend aristocrat.
High growth.
Zero DTE or meme stocks?
Oh, man. How about neither?
Oh, no.
What's he going to say, Aaron? Because he doesn't like the question either.
I don't know what he's going to say. I don't have a crystal ball.
Neither. That's a good one, though.
Neither. Oh, he said the same thing you did. Oh, my gosh. There
really?
you go. Yeah, he said neither.
I couldn't believe it was a question. So.
Thematic ETFs or passive index funds?
Passive index.
Crypto or sports betting?
Oh, shoot. You got to wait for me.
That's all right.
You were in agreement with that one? Yeah, okay.
Yep.
Long-term capital gains or short-term profits?
Oh, my word. Neither.
He doesn't like it either.
Long-term capital gains every time.
Long-term capital gains.
Bulls make money or pigs get slaughtered?
Oh. Pigs get slaughtered.
Pigs get slaughtered.
And finally, Philly sports or Wall Street action?
Philly sports.
But go Bills.
Okay.
Neither.
That's
a trading question. Flight to Vegas or, day trading, right? Oh, man.
Okay, so here's the deal. Any of those in particular you want to share your thoughts about?
I'm glad you did this. You always have this way of bringing out what people are thinking about. And I would add that I think that you're a big reason that this program has grown as fast as it has. So we have one of the fastest financial planning kind of economics and investment programs. Overall finance programs there, decision-making programs in the U.S. So my comment on these is, first I said, let's not be buying. Okay, so I don't want to be buying. And then I said, let's go ahead with buybacks. Okay, buybacks are companies buying back. All right. So do companies want to buy back at a high price? No, they don't. I am not a fan of buying in any respect, except to say that I think we have a correction around the corner. Okay, so if I'm a company, I'm going to be looking at buybacks before I'm going to be looking at, I perceive that question to mean added dividends. Okay, so if you have a current dividend, maintain it. If I got extra cash on hand, I'm going to look for a buying opportunity around the corner, right? As I am with individual investor capital, by the way. So just because I'm not buying right now, right? I'm sitting tight, I'm holding cash and those things. I'm letting gains be gains. Waiting for a new year, frankly, from a tax view. That's all to say, when the correction comes, there should be a neat opportunity to buy, not at a bottom, because we can't pick it, but off of a bottom, which we can sometimes manage to do. So looking forward to that opportunity.
Any others that you guys deviated on that you want to point out where you differ? You said he's more aggressive than you are at one point.
I mean, the T-bills versus high yield would be a good example. As we get into more skittish markets, more fractured markets, an environment where credit is stretched. Okay, high yield is a less it's going to look really good, but it's going to be a less stable place to be. And it also matters what kind of an investor you are in that context, by the way, right? So you're talking to a total return investor, right, who isn't looking at cash and bonds as the engine. I'm looking at them as stabilizers. And then what I'm doing is I'm looking at price and interest moves combined, right? And I'm hiring managers that are managing those areas. Okay, so I sit in a very different place. I think this actual episode we're about to finish here will clarify some of that. So yeah, all to say high yield. I do hold some high yield. I think it's fine. But if given a choice in the current environment, and I have a new dollar to invest, I'm not going to opt for high yield. Right, high yield moves more like equities, right, which are what? They're fairly high priced if you haven't noticed. Mm-hmm. Okay, I don't know what happened in your portfolio the last 3 years, but for most people, big returns. So that just says what goes up must be moderated.
Mm-hmm. Right? There you go.
Okay, what's next?
That's it, brother. That's the noise.
We're done. Okay, so we're back. We're back into our core content for today. What we want to do is dive and look at the value of advice, okay? And there are 4 or 5 points that I want to share with you. I may not get to all of them, so I'll just start with the first one, and that is the value of advice requires knowing what fee types and amounts you have. Now, in the past, I've done a little bit around, you pay for what you get, and knowing what that is, and those things that you can get off of reports. I encourage that. I want you to have those conversations, but really knowing what fee types are is a different angle on the same conversation. Okay, so when you go to measure advice, knowing what the underlying costs of your holdings is. Okay, I don't mean stock you bought directly. That just has a transactional cost. Okay, I'm talking about you're being advised here. Okay, you're being advised maybe directly by a fund or ETF manager. You're being advised by a separately managed account manager. Okay, I have friends that run separately managed accounts, and they charge a percentage on assets to do that. All right, my firm is an asset aggregation firm. Our fee is billed as an advisory fee. Okay, so what is the fee for that? All right, but knowing what the layers are, what are the underlying costs, what can't you see, and what can you see? Okay, and putting those together. Okay, so the different fee types and the percentages or amounts. All right, there can be a variety of different kind of versions of the same thing when it comes to advisory fees, by the way. That's beyond the scope of this. What I want to say is know the fee types and know the amounts. All right. Point number 2, the value of advice requires very little about the vehicle type. Okay, unless you're your own separate account manager, which a lot of people are. And remember, there are a lot of experts out there right now with a 3-year-long bull market. Okay, if you're your own account manager and you're buying individual securities of some kind or doing options or that, the fee structure is just the transaction fees you're paying. That's it. Okay. Again, that's not who I'm addressing in this particular episode. So everybody else that holds funds and ETFs and SMAs and, some kind of managed asset, I submit to you that the vehicle itself is not important. Okay. So whether it's a real estate investment trust or a closed-end fund or an exchange-traded fund or an open-end fund or some, separately managed account, it's not the vehicle. It's not the packaging that matters. How that thing behaves in terms of packaging, super important. Okay. Right now we're just talking about valuing advice. Okay, and that just means that the vehicle type isn't a big deal. All right, so that's the second point. The third point is that the value of advice requires aggregation. Okay, and that's where we were through all of November. And aggregation just means what? It means tying together all the different accounts, wherever they are, all the transactions, all the history, all the holdings. Okay, looking at them as one. Hoping, and it's usually just just that. It's hoping, not really getting 1 + 1 to equal something more than 2, or as I put it, 1 + 1 = 3. Okay. So doing the aggregation, that's critical for the value of advice. That's why we spent so much time on it. Then also, yes, the correlation analysis. That is critical for the value of advice. So do I have everything going together, or is it moving in separate ways? Okay. It being what? It being the areas of the market that I'm invested in. And yes, then the holdings. Okay. And last, boy, we did get through 5 here, Chaz. The value of advice requires measurement. Okay. So I want to share with you how valuable this really is in a simple example I just finished today. And this is a family friend. And if he's listening, that's great. I hope he, embraces this whole message. And so I ran at 2025 through November. This is just an example that I'm going to share with everybody, where we had a little over a $3 million portfolio. Okay, if I'm right, actually right at 3 million. I'm sorry. So a $3 million portfolio generating, the number was, let's say it was 17%. That's what sticks in my mind. It's not in front of me. But they were lagging 2% on the overall over the past few years, including 2025. Okay, and I say few years. It was a 3-year running rolling average through November 30th, 2025. So think about what I just said. 2% on $3 million is what? I mean, this is before fees. So if I attach a 1% fee, this isn't exact math, right? Fees come off of assets, not off of returns typically. But for the sake of conversation, it's pretty close. You could say, okay, I lagged 2%. Maybe I paid an advisory firm somewhere 1% on both sides. Oh, guess what? I still lagged 2%. Did that make sense? So I ran a before fees analysis. We ended up with an after fees analysis in conversation here. Either way, I'm lagging 2%. So 2% on what? On 3 million per year. And I'm just going to say in 2025. Let's just say it was a 3-year rolling thing. Let's just look at this year, right? So I'm down, $60,000? Now, the wise investor who's listened to something about this program and our scoring system and the ideas and the aggregation process we put together and promoted would say, oh, well, at what risk? Maybe that's you, Chaz. Well, what's the risk? The risk was the same, right? So we had the same risk level, but we're lagging in return. This one client is lagging, a prospective client, actually not a current client, lagging in return 2%. On $3 million. That's $60,000 in the last 12 months. All right. So I'm oversimplifying this on purpose. But I mean, what kind of Christmas would you have, Chaz, with $60,000? What kind of giving effort would you have with $60,000? What kind of, ministry effort would you have with $60,000? So, this is real. That was actual data I just ran today. So when we talk about this, I want to refer back to this optimization calculator at FideireAdvice.com. You can go out to Fideire Advice, that's FIDERE Advice, or Fideire Advisors, ORS.com. And in the footer of the website there, you'll see Portfolio Optimization Calculator. And you can just take an aggregated report of all of your holdings, your risk and return scores. You don't have to send us a single contact point. You can just use it, okay? Just go out and figure out, use a risk-free rate of return that's reasonable, and away you go. So in this particular case, the optimization score was 3 points higher on the optimized model, okay, than was the current holdings. All right. Does that mean that, they're both very positive numbers, okay? If I just look at returns of 17 versus 19, who's complaining about the 17? Right? So that's why this gets missed. See, like what we just said, the why behind it has to do with correlation. Okay, typically. What I'm saying here is, though, no one pays attention to this because they're sitting down at Thanksgiving going, well, wow, we just had this great year. Isn't this amazing? Honey, what are we going to do? We just paid 17% on $3 million. Okay? You know, what spouse do you know, Chaz, that would go, well, yeah, but we could have made 19.
Yeah.
I ran this optimization calculator on this videocast, this podcast that I heard. And, you know, I actually asked for a report because I signed into their Fusion program. And you're scratching your head as to what Fusion is. And you get the email and you go, oh, here it is. Wow. Okay. Now, is that a guarantee of the future? Nope. But it is an indication of how risk and reward are working together. Okay. And if we can flatten out risk or just kind of manage risk, keep that in line, so to speak. I like to improve on it, by the way. That was kind of a minor failure in my own head. But just to put it in numeric terms, what was missed by that family from an optimization standpoint, not a return standpoint, was around $60,000 this year. Okay. So kudos to them for having a great year. Kudos to a lot of people that are. Bull markets cover this up. They make this look like it is not necessary because everybody's talking a good game. Everybody's got a great idea. Everybody knows what to do. And then we get a correction or a bear market. And then everybody starts to look around. Okay, well, there's a good spot for that in optimization conversations too, right? That is a good spot for them, I should say. But the comment here is, oh my goodness, let's use that calculator. So how will you proceed? Will you be doing the same thing with the same people in the next quarter, the next year? You know, we're going to get into a year kind of recap of 2025 and a look ahead at 2026 in the next couple of weeks. But how are you going to do this? Are you going to do this next year? The same thing. You're going to kind of, you know, just do what you've always done with the same people or let them do what they've always done? I encourage you not to. And I've not once, and Chaz, you hold me to this, I've not once come on this program and said, oh, you should do business with our sponsor.
No.
Okay. You have to do this because I've got this great thing and man, I can't wait for you to try it. Okay. If you know a place to go get the data that you can put into a free calculator where, you know, nobody's tracking your stuff on this website at fideradvice.com. Okay. We don't get that far. So if you want to go out there and use it, use it. Find a way to do this. Find a way to benefit your family. Ask your investment advisor. Have them listen to this program. Okay. Watch it with them. I don't care. When the life cycle book is Chaz, it's just a long road with that book this year. But when that thing is finally sitting where it's supposed to be on shelves nationwide, it came out and now this was an issue. But when it's more widely distributed, I keep saying, before year end, miraculously, I hope, then you can buy that too. And if you want to write into our program, I'll send you one and I'll send one for your advisor too. Okay. So you can go to team. In fact, our email address is team@astewardsview.com. That's team@astewardsview.com. Don't forget the A before a steward's view, and that's stewards plural. So, or possessive. But with that, how are you going to proceed? Are you going to do the same thing? Are you going to let your advisor do the same thing? Okay. Or can you take the data points that you're given here, right? The perspective that you're getting here, and go into a new year ahead, no matter what the market environment, no matter what the news flash. Okay. You can listen to all of our economic stuff on this program over the course of the past 9 months now and find out that we're pretty darn good at it. Okay. And I submit to you that most of it doesn't matter as much as this. And your goals certainly aren't funded by that stuff. It's funded by this. Okay, so that's what I want you to take away from this. And I so look forward to 2026. We're going to have a great year together. There's going to be a lot ahead. I won't unpack all of that right now. But what will you do? So we've covered a lot of ground here. Chaz, unless you have anything else.
No, man, that sounds great. I'm looking forward to our next episode.
Me too.
Get some good stuff.
Yeah,
good stuff coming.
This has been a joy. And, year end is ahead. We're going to review 2025, as I mentioned, here coming up in a week or two, and then look ahead to 2026. So we've covered a lot of ground today. It's been a joy to be back with you. I hope this session has been a blessing to you and others you decide to share it with. Next week on ASV, we'll move from the value of advice to year-end planning. What can you do at the end of the year to maximize wealth? What are the things to think about? How can you look ahead to next year and put the two together? So, meanwhile, we invite you to connect with us online. You can do that at astewardsview.com. From all of us here at ASV, we look forward to connecting with you again soon. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.